All right. Good afternoon, everyone. I have 12:29 on my clock here, so we'll get started in just a minute. Looks like people are starting to roll in here, which is great. Hopefully it's not just my mom and grandma and everyone else rolling in. Hopefully it's also all of you amazing 401k participants out there as well. So we'll just wait 1 minute and we'll get started here. Okay, looks like it is 12:30 on the dot. I'm a big believer in start on time, end on time, so let's get things started. Good afternoon, everyone. Welcome to the Tele, another beautiful day here in Rochester. Always blue skies. I'm glad you're able to join me. Excited to talk about 401ks today. So first, my name is Craig Gingerich. I'm a certified financial planner, accredited investment fiduciary, a certified health savings advisor here at Sage Rutty. A couple of the ground rules, which you're probably familiar with, targeted 15 minutes, make this as valuable as possible. If you don't mind saving questions for the end, definitely have time at the end to address them. And just a quick reminder that we're here at Sage Rutty always as a resource for you. It's a nice benefit through the 401k plan. So if anything that we talk about today, sparks a light bulb, happy to help address anything in life with a dollar sign next to it. So without further ado, let's look at what we're talking about today. So first is looking at some lessons that 2020 has taught us, specifically about the 401k world, but certainly 2020 has taught us a lot, the hard way for sure. The second is we'll talk about some investing basics. So if this is not your first Tele, we've tended to focus on some of the higher, graduate level classes, right? So going really in depth on some tax planning ideas and some more in-depth topics. Today, I figured maybe we could talk a little more at the 101 level, right? Let's talk about exactly what the heck you're actually invested in. And then as always, actionable steps. How do we take what we're talking about and make it something you can actually utilize in your life? So let's dive right in. What 20 has taught us, or at the very least has reminded us, the first and foremost is volatility, right? 2020 has been the perfect accelerated reminder of volatility does not mean exclusively down in a hurry. So if we pull up a chart, this is the year to date of what 2020 has looked like in the S&P 500. I think we can all agree that this part of things, right, the down in a hurry is volatility. But what's important to remember, and what we've been served a nice reminder of, is that up in a hurry is also volatility, right? And if we took a look back at 2019, which was a phenomenal year in the stock market, was an example of a huge amount of volatility, right? Volatility means that the prices are fluctuating dramatically. It's not exclusively on the downside. And 2020 has been a really good reminder in that you don't get to enjoy the upside without being able to stomach some of the downside as well, right? It's the cost of admission. If you want to be able to ride the ride up, you have to be able to stomach some of the downs that come along with it. They're connected and equally important. And as we've talked about before, the downs are the opportunities to buy so that you can enjoy the upside. The second thing that 2020 has reminded us is that you're invested in companies, right? You're buying and investing shares in companies. And I want to go through a couple things that you are not invested in via the 401k. You're not invested in Washington, D.C. As much as sometimes it feels that way, fundamentally, it's not what's happening in politics that determines what's going to happen to the stock market, what's going to happen to your account. Certainly it plays a role, but if you look at it, say you own a share of Apple, right? Apple is absolutely concerned about what happens in Washington, but at the end of the day, Congress is going to make laws, and then the companies are going to adapt to those laws and go back to making a profit, right? There's nothing that DC is going to do that Apple will say, well, I guess we don't want to be profitable anymore. That's not going to happen, right? And you're invested in the company that has this drive to make a profit. The second thing you're not invested in is the news, right? I'm hard pressed to meet anybody that says, I turned on the news today and I feel really encouraged by it. All right. Right now, things have been going really, really scary, right? And a lot of negative on the news. The stock market hasn't had that negativity, right? The stock market over the last few months has been really positive in spite of what's going on in the news. And again, that's because you're invested in companies, you're not invested in headlines. Um, and the third thing that you're not invested in is projections. I thought it'd be really interesting to take a look on the day that's been the low so far of amid the COVID pandemic was March 23rd. And so I did just a quick Google article search for that day. What you'll see on here is there's some pretty interesting ones. 9 reasons why the stock market's such a scary spot to be. There's pockets of values, but you have to be a really high risk investor. Grim news blunts this, the Federal Reserve's crisis response, right? It was all this really dire stuff. If you scroll down, I think, so these are the top 5 articles that day. If you scroll down to number 8, I really appreciated, stock market probably has one more giant coronavirus driven plunge left to go, right? And this like really, really negative tone to it. And it's the classic, the day is darkest before the dawn, right? When everyone's tripping over themselves to project the worst outcomes, tends to be pretty close to the bottom. And I thought it was pretty entertaining looking backwards at how many so-called experts were predicting everything was going to take another 30% dive. And the truth is it hasn't done that yet, knock on wood. The third thing, the last thing that I wanted to talk about that 2020's taught us is, or reminded us, is the difference between undervalued and cheap. And this is something that I'm seeing on a day-to-day basis. I have people calling and saying, hey, I want to dump a bunch of money into this because their stock is down so dramatically. And the most common ones, a lot of people dropping money into airlines and a lot of people dropping money into cruise lines and into businesses that have been beat up pretty bad because of COVID. I'm not saying that it's a terrible idea if you fundamentally think that business is going to come back, but it's remembering the difference between your stock price has dropped because of our current situation and your stock price has dropped because our current situation puts you in a hole that you can't get back out of, right? When one of my partners here, Doug, loves to mention, you can go to Walmart and you can buy hot dogs for 19 cents a hot dog, but then you have to eat it, right? Then you have to be willing to eat a 16 cents hot dog. You want to be buying into things that are undervalued. Their price has dropped temporarily, but are going to come back. You don't want to buy something just because it's cheap, right? You don't want to own a stock that in 10 years from now, could go up, but maybe more likely is going to be bankrupt, right? That is not what you're looking for. And just remember that as you're investing, don't buy just because the price is down. Buy because it's undervalued and there's a lot of potential to it. So I'll get off my soapbox there. Let's talk about what's in a fund. Let's go over some investment basics because I'm sure that this is probably pretty repetitive for a lot of you that are listening in. But I think hopefully you'll find some of this new or some of this kind of refreshing things that maybe you've forgotten. So on a very basic level, we'll talk about stocks versus bonds. Then we'll talk about mutual funds versus ETFs, which I think is a common area for people to mix up. Talk about active versus passive, talk about growth versus value, and then diversification. And a look at diversification that doesn't get covered as much as I would like. So first, talk about stock versus bond. For this situation, let's picture starting a business. So say that Craig Gingerich is starting a business, and to start it, I need some cash. I need something to get me off the ground. And I come up to you on the street and say, hey, I'm starting this business. I'm selling 16-cent hot dogs. Why don't you give me $1,000? Let's be partners. And if you made that deal, that would be stock, right? You had ownership in that company. If I made that pitch to you and you said, Craig, I don't know that I really want to be in the hot dog business. I don't want to be your partner, but you seem like an upstanding guy. How about I loan you $1,000? Meet me back here in a year, bring back my $1,000 plus bring back some interest for the inconvenience. That would be a bond. I think my industry is probably the best in the world at making really simple concepts come off horribly confusing. Fundamentally, stock is ownership, bond is loaning your money. That's all you need to know. All right. We'll start diving into some deeper layers, but fundamentally, it's just stocks and bonds. It's just owning or loaning your money. Mutual funds versus ETFs. This one they do not teach in high school for sure, but it is pretty important to understand the difference. A mutual fund is what they consider an open-ended fund. So basically, when you start a mutual fund, say they take $100 million, they pool it all together, and then they buy a bunch of stocks and bonds in it. And so that happens on the front end. And then say I want to buy a share of a mutual fund. I give them my $10 and they grow the fund, right? They go out and buy some more stocks and bonds. And then say your 401k, right? It's payday. I'm buying more shares of this mutual fund. They'll then add on more shares onto the mutual fund. But then, somebody within the fund is retiring and ready to draw income. Okay, well, then we'll sell one of those shares off, right? So they grow and shrink the fund based on the amount of people that want it. If we contrast that, if we take a look at an ETF, an exchange traded fund, a close-end fund, they started with the same $100 million. They created the number of shares, but that's the total number of shares that they have. They'll never have more shares. They'll never have less shares. They'll have exactly the number that they started with. And so if I wanted to buy a share of that ETF, I need to go in and find somebody willing to sell their stake in it, right? So there's always the exact same number of shares. If I want to buy, somebody needs to sell. If I want to sell, somebody needs to buy that share. And so it's constantly trading every second. And to give you kind of a side-by-side, mutual funds only price at the end of the day. So they only do the buying and selling as of end of day versus an ETF is trading constantly. A mutual fund is priced universally. So everybody that bought that day gets the exact same price. Everyone that sells that day got the exact same price. With an ETF, it's priced based on what the market's doing. So it's priced no matter what on what the going rate is when I want to buy or the going rate is when you want to sell. And if somebody wants to buy 5 minutes after me, they're getting a different price. And that's a really big reason why we use mutual funds in the 401k is that you don't want Bob in accounting to get a different price than Sue in finance. You want everyone in the company to get the same price. And most employers don't want their employees saying, oh my God, I need to race to my computer to sell in my 401k because this might change by the end of the day. You want it to be pretty universally priced. And then it also, because of that, tends to trigger a little less fluctuation in mutual funds and a little more volatility in the ETF on the day-to-day because it swings based on the buying and selling, the demand with ETFs, as well as the demand of the underlying investments. So let's talk a little bit about, this might look familiar, a Morningstar box. So this is a way to kind of identify what you're invested in. If we look at the y-axis here, it's large, medium, or small. Pretty self-explanatory, right? The size of the businesses that you're owning. The x-axis is less clear, and that's whether it's value or growth or the blend of the two. And this tends to trip people up. So if you picture Walmart, for example, right? So say this year Walmart made $1 million in profit and they have 1 million shareholders, right? If they're a quote value company, then they would pay a $1 dividend. $1 million in profit, 1 million shares outstanding. Everyone with the share receives $1 of dividend. The other side of the coin is if Walmart was a growth company, they would say we have an extra $1 million of profit. We're going to use that to open another store. And so the actual price of our stock should increase. And you make your money once you sell their stock. So a value is stock price doesn't fluctuate as much. You just receive your dividends. A growth stock is I'm hoping this price of the stock is going to go up, but I'm never receiving the profits as an actual check. The next layer down, as we continue to peel back from stock versus bond to mutual fund versus ETF to growth versus value, keep getting more and more detailed, is whether you're choosing an active or a passive approach to your funds. And the way I like to think about it is buying avocados. So when you buy avocados, there's kind of two strategies, right? There's the big old pile of them. So you can squeeze them and look at them and say, okay, I think I can pick some good ones. Or you can pick up the bag of them You know there's going to be a dud or two, but it's cheaper to go that route. The same goes with investing. So, oh, this is a little mixed up. An active manager, so on the left side here, an active manager says, you know what, I think I can pick the best companies. I'm going to own Home Depot and McDonald's and Chase, and I'm going to steer clear of GE and steer clear of Johnson & Johnson, right? So they're buying and selling constantly. It takes a little more work to do that, so they charge you a little more to do so. A passive manager or an index fund says, S&P 500, I'll own all 500 of them, and I'll do it for dirt cheap. So there's probably a dud or two in that mix, but I'm just going to own all of them, not try and outsmart things, and just do it for as cheap as possible. So it's a personal preference on which you think will work better. I certainly have my own opinions on it, but we're cutting short on time. So if you want to talk through which makes more sense in your spot, just let me know, and I'm certainly happy to go more in depth. The last topic for today is diversification, which sounds really simple on the surface. I want to share something that not a lot of people fully understand, and that's the trade-off when you're looking at diversifying things. So a guy named Harry Markowitz actually won the Nobel Peace Prize in 1990 for this graph. And what he showed is that if you look at how bonds react, so the amount of volatility versus their returns, you can map them down here. And then if you look at how stocks react, the amount of volatility is higher, but then their return is higher, right? And so what you would think is, as I blend the two together, it should just create this straight line, right? If I have 50% stocks, 50% bonds, I should have about halfway between the amount of volatility of stocks and bonds, half the returns between stocks and bonds, right? That's how you would logically think it works. The truth is, because they're differing asset classes, they react differently to the market. And so it actually looks more like this boomerang shape, right? So that as you add stocks to that portfolio, you actually end up reducing the amount of volatility and increasing the return. So you hit a certain point where you have significantly less volatility and still have higher returns than bonds. Or you could take on the same amount of volatility as bonds, but by adding stocks into that, you increase your return. A little bit crazy to think about. Certainly he was dealing with the entire history of the stock market, so it functions over the long term. This is not a short-term trade-off that you're seeing there, but pretty crazy to wrap your head around that it's not just a one-for-one trade-off, that you can actually, by diversifying, you're improving your overall outcomes. Pretty wild. So what did we talk about today? What are some actionable steps? First is recognizing that your 10-year plans should not be driven off of today's headlines. And in the moment, it feels really difficult. So you take a look at the news and it says, Washington considering a stimulus bill, and you say, okay, I need to run and change my 401k. It feels more ridiculous if you think about 10 years ago, what was the headline? And should you have driven your long-term investments based off of that, right? In the moment, it feels really scary and, oh my God, I need to make some changes. But if you look in the past, you're like, oh, I would have been crazy to make changes in 2008, right? The market was going poorly, but now those prices look like nothing compared to today. Think of it the same way. If I need dollars to spend in 10 years from now, how do I want to be invested? Not based off today's headline, but where I think today stands versus 10 years from now. The second is revisit your investments. So if you don't fully understand what you're invested in, take a look. Say, oh, do I have active or passive managers? Do I have, am I more growth oriented or value oriented? Is this aligned with what I think is going to put me in the best spot? And third is make sure to diversify. So by far the most common investment out there in 401ks are target date funds, are those ones with a year based on when you want to retire. Those are internally diversified. If you're not in one of those, take a look and say, okay, am I over concentrated in just one asset class? Am I just in small cap? And if I added in some large cap or some international, would it reduce my risk and increase my return? It's definitely possible. And I'm happy to run that calculation through if you'd like. Most importantly, thank you. Sorry I ran over a couple minutes on time, but thank you for your time this afternoon. Thank you for the business and trust that you place with me and with Sage Rutty. We do not take that lightly. If you do have any questions, absolutely happy to address them now. You can use the Q&A button built into Zoom. As you're typing your questions, I will remind you, my name is Craig Gingerich. I'm a certified financial planner, accredited investment fiduciary, and a certified health savings advisor here at Rutty. Always happy to take Zoom meetings, conference calls, emails. If you have questions on anything in life with a dollar sign next to it, please take advantage of our services. If you came in off the street and just said, hey, I have questions, I need some help, the going rate's $300 an hour. For anyone from the 401k plan, it's free. So take advantage of it. It's a really great benefit through your employer. We're here to be a resource for you. So please don't hesitate to reach out and ask. So I'll take a look and see if we have any questions. Doesn't look like anything's rolled in quite yet. So again, thank you for your time, and please don't hesitate to reach out if I can be helpful. Thank you, everyone.